Hello friends, so today we are going to start with our third session on market approach to valuation. In today's session we will discuss about various techniques of residual method. There are four techniques: land residual technique using direct capitalization, building residual technique using direct capitalization, land residual technique using cost and sales comparison method, and building residual technique using cost and sales comparison method. This is the IBBI syllabus for market approach to valuation, which carries 7 marks as per IBBI syllabus. So, development methods or residual methods. Whenever capitalization rate of land and building are different and out of following three data: value of land, value of building, and value of property, any two are available, then we can calculate third value out of it. So if we are available, if capitalization rate on land and building are different, number one, and if we have a value of at least two components, because basically in property valuation there are three components: number one land, building, and number three component that our value is total valuation of the property. If we are aware of these two of three values, then we can calculate third value. There are basically four possible scenarios where these methods can be used. So first scenario could be land residual technique using direct capitalization. Second method is building residual technique using direct capitalization. Third method is land residual technique using cost and sales comparison method. And the fourth is building residual technique using cost and sales comparison. So first scenario or technique is land residual technique using direct capitalization. Here valuation of land is being done considering habu of land, assuming value of building equal to the cost of construction. So let us try to understand this concept with the help of an example. For example, a piece of land after construction of building on it would generate net operating income of say 2 lakh rupees. If cost of construction of the building is 14 lakh rupees and land capitalization rate and improvement capitalization rates are 9.5% and 10% respectively, then calculate value of land and value of building. So here we have been given data. NOI has been given, net operating income of the building, cost of construction of building is given, and capitalization rates for land and building are given. So data given is NOI, COC building, capitalization rate for land and capitalization rate for building, and we have to calculate value of land and value of property. Please pause this slide here and try to solve it of your own. Solution is there. Next slide. So value of building, as we have already understood the formula through capitalization method, which is value of building is equivalent to COC, cost of construction of the building, and it is also equivalent to net operating generated by the net operating income generated by the building divided by capitalization rate of the building. So this is the formula which we are going to use. So whereas NOI of the building is NOIB is equal to NOI which building can generate individually, right? So putting data here, cost of construction is given in the question is 14 lakh rupees. Capitalization rate has been given as 0.10 or 10%. So that means NOI building, net operating income of the building is 10% multiplied by 14 lakh rupees, that is 1.4 lakh rupees per annum. So this is the NOI component of the building individually alone. So that means NOI, net operating income from the land, is equal to net operating income from the entire property, land plus building, minus net operating income from the building only. So if we subtract these two figures, then we will get 2 lakh rupees minus 1.4 lakh rupees. This is for entire building. This value is for only building. This 2 lakh rupees is for land and building total NOI, and this is for building. So difference of these two is equivalent to net operating income of the land. So 0.60 is net operating income from the land. So that means value of land is NOI land divided by capitalization of land, considering perpetual income from the property. So 0.60 divided by 0.095. This RL has been given in the question, and 0.60 we have calculated above. So that is equivalent to 6.32. So this is answer number 1, which has been asked in the question, value of the land. Then total property of the value is equal to value of land plus cost of construction of the building. So value of land we have calculated 6.32, and cost of construction has been given in the question. So total value of the property is equal to 20.32 lakhs. So this is our answer to question number 2. Second technique of residual method is land residual technique using direct capitalization method. So first was building residual, second one is land residual. So it is similar to first method, but here value of land is known and value of improvement is not known. So in previous case value of building was known, right? Here value of land is known. So let us try to understand the second technique with the help of an example. Suppose market estimates indicate that land capitalization rate is 9.5% and the improvements capitalization rate is 10%. The land value is 4.50 lakh. Property has annual NOI of 2 lakh. So calculate value of building and total value of property. So here we have been given data of NOI land plus building. So net operating income for total property has been given as 2 lakh rupees per annum. So this income has been given for full property. Second thing, we have been given value of land only. So here land value we have got. And third, capitalization rate for land, capitalization rate for building. So these two capitalization rates have been given. Now we have to calculate value of building and value of property. So in previous case we had calculated value of land and value of building. So here value of land will be equal to net operating income divided by capitalization rate of the land. So value of land has been given in the question, which is 4.5 lakhs is equal to NOIL, which we have to calculate, divided by capitalization rate of the land, which is 0.095. So that means NOIL, net operating income of the land alone, will be equal to 0.095 into value of the land, which is equal to 4.5 lakhs. So total NOI from land is equal to 0.43 lakhs per annum. So that means net operating income of the building is equal to net operating income from full property minus net operating income from the land. So the difference will give us the NOI from building alone. So that is equal to 2 lakh minus 0.43 is equal to 1.57 lakhs per annum. So thus value of building is equal to NOI building divided by capitalization rate of building. This formula we know for perpetual income from the property, and this formula we have discussed in previous sessions on income approach to valuation. So valuation of building is equal to NOI building divided by capitalization rate of building. So NOI from building is 1.57 as calculated from here, and capitalization for building has already been given in the question, which is equal to 10%. So value of building will be 15.72 lakhs. So thus total property value of land has been given in the question, and value of building has been calculated in the question. So total value of the building is 20.22 lakh, which is answer to question number 2. So third scenario for land residual technique is method is land residual technique using cost and sales comparison. So in previous two methods, valuer must have knowledge of land capitalization rate and improvement capitalization rate. So in both the methods which we have discussed in previous slides, we were given land capitalization rate RL and also R building, capitalization rate of the building or improvement, one and the same thing. In urban areas or highly developed areas, there may not be adequate or enough vacant land sales transaction data to establish a market land capitalization rate. So the challenge in case of urban area, we may not get adequate number of vacant land from where we can calculate capitalization rate for the similar type of land. So in such cases, it is not possible for valuer to calculate separate RL and RB. So in practical scenario, it would be difficult in certain cases that RL and RB we may not be able to calculate with suitable justification. Thus combined land and building capitalization need to be estimated and established using following step. So in that case, if we do not get vacant land, so then in that case we can estimate or justify combined capitalization rate for combined structure land plus building through following steps. So first, calculate market value of total property, which is equal to land plus building, either using sales comparison method or income capitalization method, which we have discussed in previous sessions. Calculate depreciated value of the building using cost approach. In detail we will discuss in subsequent session, but brief we will discuss, relevant portion we will discuss in current session. Market value of land then market value of land will be equal to market value of property minus depreciation value of the building. So let us try to understand this third scenario with the help of an example. Using sales comparison approach, an 8-year-old property is valued at 74 lakh rupees. Using the cost approach, replacement cost new. This concept we have discussed in session number 1 of real estate, valuation of real estate. Replacement cost new of the improvement means building, is calculated to be rupees 32.60 lakhs. Calculate value of land assuming 1.5% annual depreciation in the building. So here data we have been given. Age of building is given as 8 years. Value of property is 74 lakh rupees. Total property, land plus building. Then replacement cost new. If we RCN, which is also called RCN, is equal to 32.60 lakhs and annual depreciation is 1.50%. So value of land we have to calculate. So since RCN of the building has been given 32.60 lakhs, so percentage depreciation for 8 years, annual depreciation is 1.5 years. So since age of the building is 8 years, so the total percentage depreciation for 8 years of the building is equal to 12%. So then that means depreciation amount for 8 years of the building for the building is RCN into percentage depreciation, which is equal to 32.60. It is given in the question, and 12% depreciation, cumulative depreciation for 8 years. That means 3.91 lakh rupees is the depreciation on the building. This question can also come. Calculate depreciation and calculate depreciated value of the building. So then next, what is the depreciated value of the building is equal to replacement cost new minus depreciation till date, which is 12% of the RCN. So 32.60 minus 3.91 is equal to 28.68. So this is the present depreciated RCN, replacement cost, depreciated replacement cost of the building. And since total property value of 74 lakh is given in the question, so 74 lakh, which is property, total property value minus value of building, which is 28.68 lakh. So difference between these two is equal to 45.32 lakh, which is equal to value of land. And this is the answer to the question. The last scenario of development method or residual method is building residual technique using cost and sales comparison. So this method is similar to third technique. However, here value of building is calculated subtracting value of land from total value of the property. So here we calculate the value of building. Let us understand this concept with the help of an example. Market value of a subject property is say 22 lakh rupees. Sale of unimproved plot in the area indicate that the underlying land value is estimated to be 2.5 lakh rupees. So total property value is 22 lakh rupees, and as per market survey, empty without construction, if some plot is there, that plot is having an estimated cost of 2.50 lakh. Calculate value of building using residual technique. So here data given, value of property is given, value of land is given. So value of building we have to calculate. So it is straightforward. Value of building is equal to total value of the property minus value of land. So it's a straight question, and 2 lakh rupees is given in the question. 2.5 value of land is also given in the question. So difference between the two is equal to 19.50 lakh. So this is the answer to the question. So thank you very much for watching this third session of market approach to valuation. So before I'll proceed and will tell you about what we are going to have in subsequent sessions, I would request you to please subscribe to this channel and click on bell icon so that you will be immediately notified about upcoming sessions as soon as I upload the sessions on YouTube. So next session, session number 4 on market approach to valuation in this series, is going to discuss about theory and example of the various concept of hypothetical plotting method. So these are the 5 methods: hypothetical plotting scheme for large size plot, then hypothetical building method, belting method, recessed land method, landlock concept. We'll discuss theory, examples and case studies. Important chapter, question may come out of it. And in last session of current series on market approach to valuation, we're going to discuss about structure of JV, real estate JV agreements, JV development methods, and example and case studies on JV. Thank you.